Good morning, it's Jeffrey Cohen. How are you today? Markets are going to be opening in about 2 hours. It is Tuesday, June 28th, and we're going to demonstrate our model run for you. We did this a month ago. We're going to do it again. We'll share some of the technical behind the scenes, but not a whole lot. We're going to talk to you about what the model says. It actually, there's a lot of good info. And I'm going to touch on the game theory, which we have been watching, and I think it's actually true. It's actually playing out the way I expect. We'll talk about the futures, and we'll talk about, whether markets are up, just to net it out. We're wearing a green sweatshirt today because the market is supposed to open green. You're up between 0.5% and 1%. The Nikkei is up. It looks like almost 2% overnight. Europe's up. The VIX is down. So I love this, by the way, because the VIX being down means people are willing to pay less to insure their portfolios. They're more confident. What it really means is that the volatility of the S&P 500 is expected to be lower today than it was yesterday, which is odd because our data is showing that the volatility of the S&P 500 is up and continues to increase. I want you to think about that for a minute, because this is one of our key points of the whole video, and I think we're going to do like a little set of sticky notes here for you, and you're going to have your notes to take away at the end of the video. So the first is that S&P 500 index price volatility is up and has been up for the past few weeks, rising slowly and consistently for the period of the past year, which is a rolling 253 trading days. So price volatility is up. Okay, Jeffrey, that's interesting. So there's an implication to that. What does it mean, right? It means that you should demand a higher expected return on your stock investments, all things being equal. I love pumpkin. Every time. Where is he? No, he's fine. Oh my God, on this show we have dead air. You're never supposed to do that. So, you should demand a higher expected return on your stock investments. What does that mean? That means that you should want stock prices to fall before you buy any more. So, call for lower stock price inflation. That sounds funny, right? Because normally you want stocks to go up. But if you're buying stocks and the volatility or risk in those stocks is higher, then you actually want stock prices to go down before you buy more. So that's kind of point one, and that you got to wrap your head around that. And when the VIX goes down, so the VIX down to 27, which by the way isn't that low, means the market sees lower risk, which means it requires lower return, let's say, than yesterday. I'm not buying it at all, by the way. So we look at the futures. So let's jump right into it. So we ran our model yesterday, and we made it much deeper. So we use a seated Monte Carlo. I got notes right here for you guys. We've seeded Monte Carlo. I upped it by 20% more portfolio sizes. We have an unseeded Monte Carlo, which is truly random. We added 50% more shots. We have an exhaustive genetic algorithm which tests every combination of every portfolio against every portfolio, takes the best one, goes to the next generation, takes a certain number of them that we tell it. I think in this case it's 23. The 23 best portfolios, and it genetically mutates all of them. And it does this like 300 generations. So we added 2 more portfolios every generation for it to mutate. We have a fast genetic algorithm which just says it's like a dating site for venereal disease. We get the best portfolios together, let's say 12 of them, and we just kind of randomly mix them up. Maybe 12 portfolios each date 2 or 3 portfolios for that period, and then that happens generation by generation. Both can get you to the best answer, by the way, but the fast genetic algorithm, the random one, is less efficient, takes longer to get there. Most of the time, not always. We have a bespoke simulated annealer that we added 25% to the shots. So a simulated annealer deals with heat. It's the metaphor of heat, because the computer isn't any hotter, right? So the metaphor of heat says that we're going to look across the whole environment, and when the temperature's hot, we're going to jump from point to point. The analogy in QUBOs, quadratic, unconstrained, binary optimization problems, which is the model for our system. It's a QUBO. So the model for our system says, Jeffrey, you got to find the best portfolio. And I'm going to hide. I'm not going to be that easy to find. And so you got to look. You got to really look for it. So when the temperature's hot, it goes all over the map, which is a huge search space. And it runs and it runs and it runs and it runs. And it keeps the best one. But it actually will jump to maybe less attractive ones, looking around. And then it'll look for deeper pockets in those areas. And it does that a lot, but as the temperature cools, the metaphor for temperature cools, then it wants to just focus deeper and deeper into the one local spot where it's at. So we had to just do more shots. Then we went back, we have a second set of Monte Carlo runs, and we just made those 50% more shots. We have a exhaustive genetic algorithm again. We added a few more portfolios so that they, everyone gets married to everyone in that one and has generations. Then we have our regular simulated annealer, which we deepened again. We have a reverse simulated annealer at the end, and it's fine. And in our last genetic algorithm, we were having the best 50 portfolios found. And we were marrying them all to all 50. And this time we did it differently. This time we took the best 25. But we did 6 times more generations. And so at the end of doing all of this, our answer was substantially the same as yesterday. So we doubled the time of our run for substantially the same answer. And the reason is that we were not confident in yesterday's answer as much as we wanted to be, right? So now we deepened it like crazy, and now I'm much more confident. And the answer, it's frustrating, okay? The answer, the optimization of the portfolios gives a rather frustrating answer. So Jeffrey, what does it tell you? Well, the first thing you want to look at, and by the way, we'll get to game theory a little bit later. I'm going to move that. It's kind of distracting on the screen there. Let's take a look at the first deliverable. So you get a spreadsheet when you buy the run. So Jeffrey, what's on the spreadsheet? Well, it starts with an ordered list of tickers by Chicago Quantum Net Score, negatives better. You're going to notice, so the Chicago Quantum Net Score nets out risk and return. If it's negative, it means you get more return than risk. Negative's good. Return outweighs, expected return outweighs risk. So if you could only buy one stock, this spreadsheet is great. Oh my God. You want to buy one, you want to add one stock to your portfolio today. You'd get the list. You'd say, okay, the best stock to add is QQQ. Okay, that's weird because that's an index. Yes. The second best stock to add is SPY, which is also an index ETF. It's S&P 500. The third is IWM, which is the Russell. Jeff, what are you doing here? What's the model doing? So the other thing to notice is that these two are negative, and every other number in the spreadsheet is positive. So I want you to think for a minute what that means. There's only two stocks that you can buy that are better than holding all the stocks equally. If you held all the stocks equally, there's a lot of data in this thing. If you held all the stocks equally, so Jeffrey, what's the return if we hold all the stocks equally? You get a lot of data from this model. The expected return of all stocks equally is 4.26%. These are the money-making stocks. These are the profitable companies, the stocks with lower risk and higher return, or lower risk and lower return. The model's precision is 7 times 10 to the negative 9, which is pretty precise. The CQNS power under 3 means that risk and return is getting much more balanced. Your all-stock variance is 1.6 times 10 to the negative 4, which is the highest I've ever seen it. And so your expected return is 4.26. So when you look here, expected return of the three indices, and you get this for every stock, which is kind of cool. And you see they're basically running the QQQ is expected to return 5.5 based on the risk profile. Okay, it's interesting. So Amphenol, we don't really know Amphenol, but look at the next stocks on the list. I want you to reflect on the fact that these are not normal stocks to see in a quantitative model as being the best buys of an individual buy. Apple, Nvidia, Microsoft. So why are they the best buy? Well, the expected returns aren't, well, that's interesting actually. The expected returns actually are pretty high for one of them, for Nvidia, 9%. Nvidia's been bouncing like crazy, but the other one's at 5.5, 5.25. So the question is, where are we at? So then you see, let me lock. Let's freeze the header rows and let's freeze the header columns. You'll generally speaking want to have 3 header columns and freeze them. Okay. So last day volume versus the average volume for the whole year. So when you look at Apple, Nvidia, and Microsoft, Apple and Microsoft are trading below. They have less volume. Nvidia is right at 99%. If we look at the entire column, the average, so interesting, is 1.01. The minimum is 0.2%. The maximum is 1,000%, or 10 times the volume. So there are stocks like Coherent. Coherent's traded at 417% of last year's volume. It is in play. But there's one of those running at like 10 times. So what's the last day close price versus the average? Min and max. So the minimum is 7.8%. So you have a stock that's down 92.2%. You have other stocks. So one of them is 2.57. One of them is up 157%. So you can see the stocks that went up and went down. For Apple, Apple's down 9%, Nvidia's down 27%, and Microsoft's down about 10%. So, interesting. The variance. Now, this is where it gets interesting because Apple, Nvidia, Microsoft, S&P 500. So the S&P 500, when we normalize variance versus average close, and we take the square root and we multiply by my mother's birthday, we normalize these so they're all equivalent. I was making that up on my mother's birthday, by the way. So the average is 0.02. And so what you notice here, the mins are really low and the max can be 0.69. Is you see that Nvidia is 20 times more normalized variance than the others. So of course the return is higher, 9 versus 5. But wow, that risk is significantly higher, the variance of the stock price. And so if we wanted to look, so Jeffrey, what are the stocks with the most variance? Boom, Eros Media World PLC. I'm guessing that's a porn company. Then you have Grow Generation, which is a pot company. Beachbody, oh yeah, look at this Beachbody. That's number 3. And Agrify, RCM Tech. Fast Radius is the most declining stock in the entire stock market. Lottery.com, Logic Mark. So these are, oh, and an ATI Physical Therapy. This is a walking wounded. By the way, I owned ATI Physical Therapy and I made money on it, but wow, and I made and lost money on Grow Generation. These are very risky. Tons of variance. Tons of variance. Pinterest, PayPal, Forge, that was memed. PBF Energy, which a friend of mine says is crap. It's total garbage. Zoom Video, Roku, Chegg. I'm just telling you, there's weird stuff out there, right? But hey, Jeff, that's great because now you can look for the Broncos that you might want to ride, the crazy stocks, right? So we're going to go back to I knew it. Hang on, time for a cat cameo. Oh, wait. Hang on. Okay, where are you? Okay. Sorry about the extended delay, but Pumpkin escaped the yard and ran off. And the neighbor had a big dog barking at Pumpkin. So, sorry about that. There's too much to walk through here, I realize. So, the other thing you look for is the average discount yield. And then I have some other data, market cap. So some of you may want to make calculations on valuation. So there's market cap, there's cash flow from operations, there's long-term debt, there's net income, there's common equity. Think of that as common shareholder equity. There's AOCI, which is accumulated other comprehensive income. Most of those are negative. By the way, if you see a 999, on all of these, 99s means, it's an old programming trick, right? 999s means that our data provider did not have data. So we can very easily find and highlight out of our model and just, there. Done. So AOCI. Now you notice AOCI for most of these companies is negative. I'm puzzled, right? Like Apple has $6.5 billion of negative income. Now you compare that to how much they actually made, and they made $102 billion. You think it's not that big of a deal, right? So in this particular case, AOCI divided by net income, it's going to be like 6%. Yeah, not a big deal. For other stocks, it is a big deal. How is it going for Timberland Bancorp? No, that one, it's not a big deal. You'll see. There are certain stocks where it's a big deal, and so you want to manage that. Then you have their short-term and long-term investments. Now, this one, no data means no, means zero. But there were a few of those stocks that had stuff in there. And then intangible assets. So Apple does not have any intangible assets loaded in the system. Microsoft has quite a few, though. So you might look at Microsoft and you might say, so what are my intangible assets as a percentage of my book value or my common equity? So let's take a look. Intangible assets divided by common equity. 7%. It's not a lot. So you say, all right, that's pretty healthy, right? Microsoft, which should all be intangible, patents, things like that. Nope. They got money in the bank. That's what you should be looking at for Microsoft. And so we go through and we use all this data, as can you, if from our upruns. These are all profitable companies with positive cash flow from operations. So it's great when you see the cash flow and you compare it to net income, because in most cases those numbers should be about the same. When they're not, then you know there's some issues, right? So you want to look at cash flow and net income. So you end up with all this data and you have a sense of whether a stock is good or bad. So people will call me and be like, hey, what do you think about McDonald's, right? And I can very quickly go through McDonald's and say, well, so it's pretty good, right? The CQNS score is not bad. It's expected to return 3.1% in next year. That's inclusive of dividends. Traded 72% volume, so it's not really in play. It's up 1.5% over the past year versus the average price of the last year. Variance, pretty low. Low variance. It's nice, right? McDonald's isn't going anywhere. Pays you a 2.2% dividend. Market cap, and we can walk through the different valuation metrics, right? And so it works. What happens is you can really talk about a company this way. You can really make some decisions, right? Market cap is $185 billion. Generated $9 billion in cash flow, so it's trading at roughly 20 times cash. It does have long-term debt of $34 billion, which is fortunately less than their equity. Net income is $7 billion, so it generates $9 billion in cash, $7 billion in net income. So there's some shielding going on. Common equity is negative $6 billion. Wow, they did something weird. They don't have any equity, and their AOCI, which is their accumulated other comprehensive income, is negative about $3 billion. So my guess is that they're losing money off the balance sheet, off the net income statement, that will get, let me explain it differently. So AOCI are true income items, but they don't have to be reported in your net income statement. They do, however, have to be reflected in your balance sheet. And so they lost $2.6 billion in the past year. They probably lost $2.6 billion every year. And so now your common equity of the company is in the garbage here. It's negative. So you're buying McDonald's, you're buying a company that's valued at $185 billion. It's carrying $34 billion in debt. It makes $7 to $10 billion, let's say, a year in some kind of income. But it's losing $3. And at the end of the day, it's not holding its own. Its liabilities keep increasing. So McDonald's is a stock that you would look at and say, I'm not comfortable. It's got negative common equity, which is terrible, by the way. It's got negative AOCI. And really, I don't understand, Jeff. Why is it in trouble like that? If you look, there's a lot of companies with negative common equity, stocks that haven't done very well lately. Philip Morris has been in the toilet lately. It's gone down a lot. Starbucks has gone down, and I noticed the Starbucks by me stopped making deliveries of food, so that they would share food across the different restaurants and share inventory. I mean, I get it. But you have store employees getting in their car and bringing creamer and soy milk and those little sandwiches and whatever to different stores to save money. I get it. I like to save money. But I look at that and I think, I'm not sure I understand why you would do that. But now I know, because you have negative equity and you're trying to help yourself. Yum Brands, red. God, if I'm looking for a set of stocks to short, I'm looking at stocks that have negative equity. Let me guess. AOCI is going to be negative too. Well, what's interesting is Lowe's, it's not. So Lowe's is making money off the balance sheet. But we look at these. It's a fair amount of dog shit here. Why did Philip Morris lose $10 billion basically off the income statement? How much did they make? Oh, no. No. Say it ain't so. Because this is going to explain why Philip Morris fell and it has nothing to do with what everyone says on financial Twitter. So Philip Morris made $9.6 billion, and Philip Morris lost $9.7 billion. So Philip Morris is losing money. How are they going to pay all this dividend? They got 5% dividend. You got no money. Now maybe you got cash flow. You do. You got $11 billion in cash flow. But so suddenly, the story is a little different. Philip Morris is a company that generates cash but loses money. Okay. So, hey Jeff, thanks. That was great that you give me this chart every day. If I buy your service, and you can teach me how to use it, and we can find stocks, and we can go long certain stocks and go short certain stocks, and we can figure out the story behind their earnings. Maybe they have negative earnings somewhere else, right? So that's one thing that you get. The other thing you get is you get the actual run. And so this is pretty exciting stuff here. So I'm going to go over the run part tomorrow. Okay? So we're going to come back, take a quick look at the futures. I'm going to wrap up the call here. If you're interested in buying a run, check out our website, which is www.chicagoquantum.com. You just go in and type chicagoquantum.com. The first thing you need to do if you're going to buy a service, I mean, you can read all this stuff. It's great. Please take a look at the brochure on the main page. We also have a brochure summary, which is a threefold, which is nice. We mail it to people. So our brochure talks to you about the fees, the terms, the conditions, everything. Wow, the prices aren't right. I got to fix that. So look at the brochure. Check it out. Wow, it has to be updated. I'm so sorry, it has to be updated. It's from December. And but that's fine. It'll still tell you about how to do business with us. And we can invoice you if you're like a company and you want to buy more than one run. Be happy to invoice you, all that good stuff. Business to business. And then you go over to the quantitative stuff, quant analysis, and you buy a run. You can, first off, I probably make this website really bad to buy from because I describe everything. The value prop, how it works, what you get, and then you can come over here, you could buy a run. $750, you get what we talked about, and then tomorrow I'm going to go through the actual run itself. The first was just a spreadsheet, and then how you use it. And so that's great. Thank you. If you like the video, hit subscribe. If you want to get questions, leave a comment. If you want to reach us, just look at contact. And we're going to close out with where the stock market's going to open. The stock market is going to open green today. It's going to be a great day in the market. I hope everyone makes a lot of money. Interest rates, however, going up. So interest rates are going up. Stocks are going up. Oil's going up. Everything's going up. Except for the VIX. Everyone's calm. By the way, I'm wearing a green sweatshirt. But just so you know, we do not see this market being green. We see this market being red in a committed downturn. So I want to thank you very much for watching. Appreciate it. You take care now. Bye-bye.